This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
How you going? It's Phil Tarrant here, host of the Smart Property Investment Show. Been doing this for a few years now. I've had our people sort of have a dig around and try and work out when we started this thing, and it's been quite a while. And we're marking, a point in time where we've had significant amount of downloads. Traffic, the downloads on this podcast just increases by the day. It absolutely blows me away how many hundreds of thousands of people now download the Smart Property Investment Show every single month. And it just makes me realise the responsibility that I have to make sure the commentary that I'm having with people across the breadth of property is appropriate and reasonable and considered and in line with the outcome that we all want, and that is the inherent value of property, how we can all be as property investors to create value, and whatever value means to you and what you want to do with your money is completely up to you. But we'll maintain the coverage. As part of the work that I do inside and around property, as part of it, you'll hear it sometimes on Smart Property Investment. And for those of you who are sort of fans of and viewers, listeners of Tom Panos, real estate coach, he's from the Real Estate Gym, one of Australia's great auctioneers, coaches, real estate agents. So I do a regular weekly Zoom with him, live stream on all the different social channels, normally on a Thursday around lunchtime. You can view it live on the Tom Panos page or any of the pages like Real Estate Business, etc., where we muse about what's going on. It's called Real Estate Exposed, and we look at the big issues. We go behind the scenes of real estate. We have the conversations that most people in real estate want to have but can't have or shouldn't have. We're happy to sort of push the boat out and challenge some of the well-grounded assumptions in real estate. We poke, we prod, we push, and we give it a bit of a go, and we both enjoy it. And in our unique particular lens, we have a good time doing it. But last week, I had a really good conversation with Tom, and I posed a sort of challenging idea to him where I said, it's actually no one's market in real estate. And by that, I meant we're all being brought up as from kids thinking that in real estate, it's either a buyer's market or a seller's market. My point to Tom was that, well, it's no one's market at the moment because of just the stagnant stabilisation of property. Now, we viewed that within the lens of what it meant for real estate agents, because we have a lot of listeners on Real Estate Exposed within the real estate fraternity and the mortgage broker fraternity, and they're one of the biggest losers when it comes to a market in stabilisation or a stagnant market where there's little transactions on the buy and the sell side because agents make their money through commission checks when property is transacted. So a slower market means real estate agents get hurt, and that's the view that we had with that particular conversation. But this idea about it's no one's market, this idea around a market in stabilisation, I want to take a lens of that from the investor. And I spoke briefly about it, but I've asked Steve Waters from the Right Property Group to come and have a chat with me to challenge this idea around it's no one's market. To challenge this idea is that we're in this period of stabilisation. To challenge this idea that potentially we're at the bottom of this market cycle and the only way here from is north. But in a market that doesn't belong, or a market that doesn't lend itself one way or the other, the balance of power to the buyer or the seller, as in it's no one's market, is that a good environment for investors to operate with? And you might be thinking, well, it doesn't matter, Phil, why are you even talking about this? You don't know what you're talking about. And I was probably the first to say I don't know what I'm talking about, but I'm pretty good at finding people that do know what they're talking about and asking them the right questions. And that's my job. Steve Waters, how are you going?
Yeah, going well. That was a great introduction of yourself by yourself. I don't know a hell of a lot, but it was
the important thing, Steve, I ask, I'm good at asking people that know what they're talking about questions. The big question for you, mate, is do you actually know what you're doing these days? In this market, at least.
Well, I think the expression that you coined, it's no one's market, I think that's a superb way to, I guess, commentate on it. It really is no one's market. But I guess
I'm going to own this idea, Steve. I'm going to say I'm going to lay claim. I lay claim to two things over the last 6 months.
Yep.
Number one, I called it in winter. I said there will be no spring selling season. And number two, I said it was going to be a very lackluster spring selling season. I said it's not going to be what it has been before. And I had all the reasons why. I've been chatting about it on the Smart Property Investment Show. I chat about it with you offline and online on Investing Insights with the Right Property Group podcast. Chat about it with Tom Panos. And these are all different people that see the world from a different angle, but all inherently connected in with property. So I said, spring selling season will be nothing. Will be a bit of a
non-event. Yep.
Non-event instead of a non-event. And then this idea of there's no one's market. I don't know if anyone else has really sort of given it that monkey yet.
You have.
I have. So,
and it's yours to own.
Mate, I'm but a humble journalist.
But a humble journalist.
But a humble journalist.
Look, I think your call on the spring selling season was correct, and I think you'd find a few of us were thinking the same. And in fact, I've never really bought into the spring selling season analogy or hype and everything that goes along with it. I think in particular areas it does mean something, but for the vast majority of areas across the country, the spring selling season, if anything, just means a little bit more of a bump in listings as people become more agile, I guess, or mobile between their ears, and great time to sell, the flowers are blooming, etc. But I don't think it has, generally speaking, across all corners of the country, this remarkable effect in listings and therefore buyer's choice or bigger prices, whatever it means. But in regards to the term, it's no one's market, I love it. I really, really like that. But my filter on it's a little bit different from Tom's, because as you rightly say, it's his constituents, his students are real estate agents, and that's around transactions. So they get paid when they sell a property the way it should be. From our side of the fence as investors, no one's market doesn't mean the same thing. What it means to me, and this is from a very general sense because markets within markets, as we all know, no one's market means it's back to a balanced scenario where there is not enough supply for not enough demand and vice versa. So we don't have a FOMO market and we don't have a FONGO market where there is FONGO, fear of not getting out.
FONGO, yeah.
So we don't have this imbalance, I guess, and I'm being, once again, quite general. What we're seeing today is in certain areas throughout the country, you could argue that it's still a little imbalanced in and around supply and demand. So there are more buyers than there are sellers. In other areas throughout the country, it is legitimately balanced. It's got this beautiful moment in time where those that want to buy have enough choice, those that want to sell have enough buyers. And then you have other areas throughout the country which is imbalanced, especially in and around perhaps some areas of Sydney and some areas of Melbourne where that affordability piece is in combination with, I guess, the reducing amount of capacity to borrow money from the bank's point of view as interest rates rise. So you don't have as many buyers, but you don't also have this massive flow of sellers who are wanting to get out to dramatically imbalance that metric. Not unlike the GFC, and I know we chatted about that not too long ago, where there are a lot of people that are drawing comparisons to the GFC. And if you really dug deep enough, I guess you could say, well, the rate of fall is greater than the GFC, and you could find evidence to support that. But generally speaking, I don't believe you can draw that many comparisons to the GFC. Totally different set of circumstances, totally different set of outcomes, even than what we're experiencing now. And for that reason, I think it is a no one's particular market. And I'm okay with that.
And that's okay.
It is okay from our side of the fence, not as an investor.
See, I don't know why, and why does it have to be someone's market? Now, this is the inherent idea in real estate, in that, real estate being inverted commas a game, buyers want to buy well and sellers want to sell well. So if you're selling an environment which is an upwards price environment, that means that you might get more for your money if you sell at the right time than what you would have done left or right of that 6 months, right? And this is the inherent psychology or psyche of real estate, is that you want to win in real estate. You want to buy at the right time and you want to sell at the right time.
That's why an auctioneer, Phil, that's why an auctioneer, that's a really good point. They want to win. That's why when you'll hear an auctioneer's narrative during an auction say, it's against you, sir, it's against you, ma'am, because they're they're trying to create that competitive.
But why does property need to be a contact sport, Steve? And it's the question: why is it hardwired into us from young that there is winners and losers in real estate, when we know most people will win in real estate if they're in real estate and they buy the right stuff and they hold on for it for a long time. So, this mechanism of competition in real estate, that it's a buyer's market or a seller's market, is only a moment in time. And some of those moments in time might be measured in weeks, right? Or months.
Yeah, and it can change around policy calls.
But change around policy, all the stuff you can't control. So we're hardwired to be competitive around real estate. It's a game of competition. You get onto the property ladder, the ladder being like a football game. You start at the bottom of the ladder and you want to be number one on it. Everything is geared around the competitiveness of real estate, when really it doesn't matter. The competition is with yourself.
Yeah, that's a good point. I don't think
one's market. It doesn't matter.
I don't think it's not a contact sport. Although I have seen some pretty ordinary things at auctions, for that matter, where it has become contact sport. But I think more the reason it's classified as competitive in its nature is realistically only for that moment in time when you're purchasing or selling.
Yeah.
It's just that moment in time as opposed to the longevity of the asset. And I think it sells paper. It gets our competitive juices going. We want to know that as a buyer that we got the best value that we could, and that we don't get buyer's remorse the very next day, et cetera. But the idea or the notion between it's a buyer's market or a seller's market and there's nothing in between, that's a media-driven scenario for the most. It sells ad space, I guess. And look, but to be fair, there have been times and there will be times where it is a buyer's market or it is a seller's market. And as I mentioned, there are some parts of the country where that be the case today on both sides of the ledger. But generally speaking, once again, if you were to somehow throw it all into a pool and average it out, it's a no one's market.
It's no one's market. And the idea that you win at auction, for a lot of people, when they win at auction, they lose because they probably bought the wrong place at the wrong time. They don't have their finances in order, and it goes on and on and on. But the opportunity for property investors is, how do you, number one, understand this market, this sort of stabilized market, and number two, where are the inherent opportunities in that market, and number three, how do you tactically capitalize on it? And I think that's really what I want to extrapolate from this chat, Steve. We'll just go to a break beforehand. Stay with us, everyone. Back in a moment. Welcome back. Phil Tarrant, host of the Smart Property Investment Show, with Steve Waters, director of Right Property Group. I think we've defined it. It's no one's market. I think we've given a sense that it's irrelevant whose market it is. Every single property investor will act and operate inside of markets, irrespective of whether they're up, down, left, right, buyer's market, seller's market. There's always opportunities. So, Steve, in this stabilised market, with sort of a stagnant, stabilised market, I guess identified by sellers don't need to sell and buyers don't need to buy, or buyers can't buy, two very different things. But if you look at other markets that we've been through, Steve, people need to offload assets. They don't need to do it. They can still afford their mortgages, even though it's going up. Family balance sheets are the strongest they have been. Job security is there. Employment is good. There's a lot of reasons why people don't need to sell. And buyers are sitting on the sideline waiting for. Buyer expectations is different to seller's expectation and seller's situation. So essentially nothing's happening, or very little is happening based on transactions compared to historical averages. So if nothing's really going on, or very little's going on, I would imagine buyers' agents in there behind the scenes trying to act in their own little quasi-market, and that's where buyers' agents operate. The cloak and dagger of stealth with your little secret spy jackets on, getting around, trying to motivate selling and buying opportunities, Steve. That's what you're doing right now. How does an investor operate in a stabilised market where there's very little pressure left and right?
Once again, being general, because there are markets that are still quite buoyant. I think the opportunity in today's market is around choice. Whereas if we go back 2 to 3 years, or over the last 2 to 3 years, buyers really had a lack of choice. In fact, it was one of the only times that I can remember where just about every square inch of Australia was heading north in value collectively. We don't usually get that. We have a market going up, one going sideways, and perhaps one is giving a little bit back. But every square inch of Australia just about was heading north because of the conditions at that point in time. Today, we are in a position, generally speaking, where we as buyers can take our foot off the tempo of the transaction. And what I mean by that is when we negotiate or when we're looking to purchase and then negotiate, usually it's around price, terms and conditions. Whereas over the last couple of years, it's certainly not been about terms or conditions. It was, we need to put our best foot forward, because we're probably only going to get one shot at this. In today's market, which is a normalized market in a lot of areas, we can actually combine price, terms and conditions. So we're not having to sacrifice what are usually our non-negotiables, which is pest and building terms, finance terms, cooling off periods, et cetera, et cetera, et cetera. So we can take a more systematic, strategic and methodical approach, which is how it should be, rather than have that fear of missing out because there's 2,000 other buyers behind me who are willing to throw their hat into the ring at probably a much higher price. So the ability for us today is to be, once again, more methodical and strategic. There are some markets where we're still having to be Johnny on the spot and be very, very quick in terms of our decisions, but not to the degree that it was, once again, over the last 2 years. So where's the opportunity? Choice, but also making sure that we've got that view on the long-term horizon, because the trajectory of growth is not linear. It's not we will get our 7% for a number every year of growth. It is the trajectory is up, but we'll go up, we'll go down, we'll go sideways, but the trajectory is up. And then we can reverse engineer the growth patterns as long as we get the areas right now. And once again, that area comes into the form factor of choice. So it's area based on our budget and our affordability. Then it's the locality. Then it's the street. Then it's the property type, et cetera, that will perform in the areas where all the metrics and components that we want are.
Are you seeing a level of frustration or jitters in your client base, the people who are hungry to buy at the moment because they might have a pre-approval that might be expiring? They might see that should they need to get a mortgage again, their serviceability is going to be reduced, so therefore they're going to have to buy less, and frustrated with this sort of sense of stabilisation in the market that they can't get what they want. No doubt that's when mistakes are made.
Yeah, it's a pretty good point, actually, because if you have a pre-approval today that expires, there's a good chance that you're not going to obtain the same dollar value approval because of the servicing calculations with higher interest rates. So there's an element of frustration there, but generally we have 3 months to find the suitable property. Where the frustration that we see within our clients or with our clients are those that are in the workup stage of wanting to purchase again and don't have the capacity or the serviceability to do so because of the current interest rate environment in combination with the increased buffer rate. So there's a lot of times where people now are being serviced between 8 and 10%, which is huge.
Yeah.
Which is huge. So the intent is there, but the ability is not, as we often talk about. And that's the frustrating piece, because as sophisticated investors, they see opportunity. Today is about opportunity, just as it was at the end of 2019, beginning of 2020 and 12 months thereafter. Great opportunity. The difference was, other than potentially the price point from then to now, is falling interest rates, lower buffer on top of that. And so the ability to borrow was easier and larger than what it is today. And there in itself is the problem for the entire economy, or for the entire industry, I guess, and around accommodation, which is clearly on the front page of every sort of article, newspaper, because there is no accommodation, there is no supply. Is, well, how do we correct that? And the only way to correct it is ultimately through supply, which equals participation. And it's not getting easier. So the problem could be here for years to come.
Could be. Might define what the market is going to look like for the next period of time until something happens to accelerate it either way. And I'm okay with that.
Yeah, I think most people are. I think people that have been doing this for long enough as investors, and we've seen the different market cycles, and no two cycles are really the same. but we're comfortable in the fact that we know that the trajectory is up and that it is a safer asset than others, and we're in it for the long term. So it is about the choice that we get and where do we get the money from and how much can we get and what can we afford.
So on that basis then, as in this stabilised property market, and stabilised as in, that on the buy and the sell equation, it's sort of washing out to be similar, and stabilised in that, I guess there's two levels of stabilisation. That's the first one. The second one would be price falls are stabilising. So we're nearing the bottom, or we're at the bottom of the market. And again, we're being general there because some markets have continued to grow through this period of time. So with that view, I'd like a sense of the performance of the different capital cities or the states. And we'll just, if you give us a quick brief on each of them, Steve, we'll just go to a break. Everyone stay with us. Back in a moment. Welcome back. Phil Tarrant from Smart Property Investment with Steve Waters. Steve, let's go around the grounds. Considering this market dynamics that we've been chatting about for the last 20 minutes, let's start up and do a lap around Australia clockwise.
The big lap. Oh, okay.
The big lap. It was really funny. I was flying up to Asia where I am right now, and I sat and watched the Top Gun movie, and I watched some other stuff, and then I sort of put my head out the window and I looked out there, and we're flying over Queensland, and I looked out the window and just went, mate, there is nothing up here. Like nothing. And I just for the life of me, I was just trying to find some sense of life, right? Just going, this is a big country, right? It's a big country. And then I worked out, I wonder where we are. And I was trying to, before I jumped on the map, trying to work out geographically where we will be flying. And I reckon when I looked, we were probably about 200 kilometres inland from Cairns. And it's just a mountainous, just nothingness, right?
In a good way.
In a good way. Oh, it's great. It's a beautiful country out there, but it's just a sage reminder how big the nation is. And a catch-all of property markets for Australia is very, very difficult to do. So we'll start off in sunny Queensland. And I do know, and that for those of you, show your kids this, right? Melbourne is closer to Brisbane than what Cairns is to Brisbane.
Well, it's as all states and territories, it's a tale of many markets, and then we could even get more granular in terms of asset type, but we don't have that time. Look, we're starting to see the confidence come back into the market of Queensland now that their state government has dropped the land tax reform, and rightly so. What was potentially going to be a flood of property come onto the market as people got out is now not happening. So that's certainly put that confidence piece back into the market. So we won't see the flood, we won't see the correction, let's call it, in terms of the growth patterns. The far north, and we could probably break Queensland into regional, far north, the Brisbane region. We'll keep it as simple as that. There are areas of far north, well, in fact, the whole of Queensland is at record lows in terms of their vacancy rate, and so that's cushioning the interest rate rises that we've had. In fact, rents are escalating at their greatest pace ever. Far North Queensland is no different. Their jobs numbers are very good. Potential infrastructure projects are very good. This change in lifestyle because of COVID has also helped to drive that market, which is here for the long run. And we would suspect that neck of the woods, so to speak, will continue to do well in its historical sense. It's not the boom that we've seen over the last 3 years. Regional Queensland, pretty much the same thing. So undersupplied that it's an absolute crisis. So we would expect it to do well. The Brisbane region, which is bound to have seen the top come off that market, and that was probably a combination of affordability because the growth rates were pretty good, but also that land tax reform. But now that that's by the way, we're starting to see that areas throughout Brisbane, which still offer the affordability and lifestyle, are doing well in the historical sense, in combination with their rental increases. So it's a thumbs up from us, but being, once again, very strategic where you purchase.
So instead of going clockwise, I think we'll go anti-clockwise. We'll go through Northern Territory, but I'll put this out there and no doubt our friends in Queensland, and particularly the Queensland Premier won't like me saying this, but the biggest influencer on Queensland property over the next 2 to 3 years is going to be the New South Wales government, purely because of how the Premier of New South Wales pushed back on those land tax reforms they're trying to put in. If he didn't do that, if the state government of New South Wales didn't do that, it'd be a very different equation for Queensland property moving forward, and particularly for property investors. And people aren't going to like me saying that, but I'm putting it out there.
I actually agree, but we'll see how short-lived that is, with the elections coming up and whether they retain or not. But maybe secretly, all the other state leaders were saying, "Hey, pull your head in, behind the closed doors. Pull your head in." That's a shocking piece of policy. But anyway,
it's good. It's good to see the federation, the independence of federation. It's funny. It's funny that less than quiet hand that New South Wales has had on shaping Queensland property markets. It's intriguing how it works.
Yeah, it is.
Anyway, Northern Territory, Stephen.
Northern Territories. Look, it's always been
Darwin or Palmerston.
Yeah.
Yeah,
it's always been a very fickle market, and it's one that I believe if people were to invest, you need to be super, super sure in what you're doing because it's very unforgiving. What we are looking at closely, it's more of a watch and see, watch and wait. For us, it'll be around the upcoming budget and what the defence spend looks like, considering geopolitically what's happening in and around the world. But even if the defence budget triples, which will, I guess, suit...
Which won't happen.
But if it did, I still wouldn't be doing anything until I saw dirt turned. I wouldn't be doing it on just a policy. I'd need to see evidence. So it's a bit of a watch and wait for us.
Yeah, Darwin market is interesting. We've got some clues in how the prevalence of importance for Darwin and security setting for Australia moves forward is just the level of military activities and exercises that are taking place up there at the moment and the global participation in those exercises. The Americans are very active in Darwin. There's been a lot of exercises recently that's involved everyone from the Luftwaffe out of Germany and the French. The French are very active in the region. So there's some clues there for the strategic importance of Darwin and the North, and extrapolating from that the needs of housing people moving forward. So keep an eye on that, property investors. But that's probably outside of our pay grade to have a chat about, Steve.
Which is why it's a watch and wait. Once again, it's always been typically a high yielding area, but we want both. We want the yield and the growth.
Yeah. Okay. Western Australia, the independent state of nation of Western Australia, they're happy with their GST credits these days. Thoughts?
Well, they're happy with their budget as well, $6 billion surplus or thereabouts.
Yeah.
Look, we're quite bullish on the Western Australia, in particular the Perth market, but not everywhere. It's not the kind of area that we just say, well, Perth and it's hour and a half surround and some of maybe the larger regional centres that we're all in on all areas. It's not the case. I think you need to be very specific in and around Perth, but we're quite bullish on it. Massively undersupplied. Probably our biggest competition as buyers there are the locals, which is always a good sign because they have confidence in their own localised economy. And it's not just the locals, it's the owner-occupier, which is very, very important as well. Infrastructure spend is good. Jobs are great. Affordability, some of the best in the country in combination with the highest income per capita. It has a lot of the ingredients, but for those who think that there's going to be, I guess, a repeat of yesteryear's boom some 15 years or thereabouts ago, that won't happen.
Prices back to those boom levels, yet they're still underwater, aren't they? Many areas.
There's some areas that have, I wouldn't call it back to it, but they're very close to it. What's interesting, though, is that their vacancy rates are probably on par with what they were during that boom where there was nothing to rent. In fact, well, here's a bit of context. A client recently took ownership of a property, let's call it a week and a half ago, and they had their first open home for rent for prospective tenants. Had 43 applications, not viewings, like applications.
Yeah.
That just goes to show you where the tempo and the cadence of that rental market is, and so we like it.
Yeah, and what about steady as she goes, South Australia?
Well, it used to be the little engine that can, it just always does a little bit, and it was a very safe harbour, so to speak. But no secret over the last few years it's done extremely well, and we've certainly been the recipient of that growth. I noticed their Premier came on the other day and bagged the state Premier of New South Wales and Melbourne. So, like, you guys have got nothing compared to us, or thereabouts, tongue in cheek. Look, I think they'll continue to do their organic growth patterns. It won't be everywhere. We've already started to see some of that, the tempo of the market back off a little bit the further you get out of the CBD and all that sort of hour surround or 45 minutes surround. But what they do have is a very low vacancy rate still. And I think when you aggregate the data over the last, if we look forward in 4 months' time or thereabouts, and then look back over the last 6 months, it'll probably have some of the best data.
How about sunny Tasmania?
We've seen the top off that now. It's still undersupplied, but we've just started to see a back off in the asking price for rent as well as more supply comes onto the market.
Is that Hobart, or is that your Launcestons and your Burnie
collectively?
And like that?
Collectively. But it'll still do well. I guess it'll do well, but if you look at its growth patterns over the last 5 years, which we've done pretty well out of, today's growth patterns and looking forward are going to be nowhere near that. And so some might say, well, look, it's collapsed. I don't think it's going to collapse. It just won't be as good as what it was. But would I be entering the market today? Well, I guess the question is, where is my money going to work best for me? Is Tasmania it, or is there potentially some better places?
Yeah, and maybe better place probably isn't Melbourne, Victoria at the moment.
Well, they've got an interesting situation, and we're not really delving into the regional areas here. We're just, I guess, going
Melbourne Central, Melbourne sort of metropolitan area.
They've got a very interesting scenario happening, being that on the surface, if you were to just look at the data, they have a very low vacancy rate and an increasing rent, and the numbers look good. But when you dig a little deeper, it's really a bounce from the massive giveaway in terms of the rent asking during the COVID phase. Yeah. And so there's a lot of areas that have bounced back to where it was pre-COVID, but not exceeded that. And so the interpretation within the data is very, very important. They also have the problem where, as we have an increasing interest rate environment, and traditionally Melbourne's not a high yielding area, we have that compression factor where it's more of a struggle to service the loan, but then to carry the loan potentially over the next 12, 18 months, 2 years, whatever it may be. And so investors are asking themselves, and this is from an investor filter, investors are asking themselves, do I really want to carry that negative shortfall or that massive pre and post-tax negative cash flow when I could deploy potentially loans elsewhere and get a better result with less pain or less hurt or duress? From an owner-occupied point of view, they've seen a massive exodus during COVID mainly to Queensland. Better affordability, better lifestyle, and you know the story. Those people aren't coming back for the most. And so there's this vacuum in and around talent that have left Melbourne.
That's a good point.
To the sunny state in particular. Having said that, you could argue that the counteract to that would be that, well, immigration is ramping up. We know that. We know that the federal government has said we need record levels of immigration, and traditionally it's Sydney and Melbourne that get those, or the largest portion of that. I'm yet to sort of, I guess, make a decision on whether they will, in comparison, get the largest portions. But then, as I say that, with the devastating floods that they've just had down there, which is going to wipe away, and this is probably regional more so, Victoria, there's probably in the vicinity of, 5 to 10,000 on the top end houses that have now gone, decimated, uninhabitable. So that's going to put more pressure on some of those regional areas in and around accommodation. So I think it'd be, coming back into Victoria or Melbourne precinct or the outer regions of it, I think you would need to have this. I think it's a great long-term prospect. For me, Melbourne's always been around that choice scenario, going back to the beginning of the conversation, and that's probably where it isn't a nobody's market. I would want to see ample choice and know that I'm, dare I say it, making some money on the way in, rather than just relying upon organic growth for the next 2 to 5 years.
And different paradigm in, I guess, you got New South Wales is a big old joint. You got some large cities in there, the 2000 postcode, but the large regional areas which are bigger than Hobart. Your views?
Well, that's actually a really interesting point, because you've got areas like Wollongong as an example, which is as big as Hobart or Launceston. I think the Sydney market is probably, it's a very fractured market at the moment, and what I mean by that is there are certain parts of the Sydney market that we've seen recede up to 20%. And that is dragging down the sentiment of the rest of the market in terms of the numbers. It's very easy to report on that. But we also need to put some context that those areas that have receded some 20% had some enormous growth over the last 3 years. And you could argue that it's a rationalisation of the market to get back in line with its organic historical averages.
Yeah.
But we're seeing in those markets people starting to entertain, if not buy the dip, in those bigger areas. And look, to be fair, they're the multi-million-dollar range, I guess, is what I'm referring to. But outside of that, the middle tier brackets, it's a bit of a mixed bag. Some properties are holding, some have dropped back 5-8%, and the same with the affordable corridors. What we're really seeing, unlike other markets in Sydney, is anything that has warts on it is really struggling. So what I mean by warts is at the extreme end, under power lines in an area that always goes underwater or floods, or on a freeway, et cetera, et cetera, et cetera. But in a more general sense, those properties that are, let's call it, cosmetically challenged. Because of the reduced borrowing capacity, people are finding it hard to buy the severely cosmetically challenged property, then have leftover capital or want to utilise that capital to spend to renovate in an environment where there's no tradesmen or materials.
Yeah.
So they're hanging back, and they're staying back. And to be honest with you, that's where I see the opportunity within the Sydney market, are those properties that are cosmetically challenged. As long as you have your contacts, your teams, and capital to be able to renovate, but challenged in terms of rental supply, as is the rest of the country, and that is the number one theme over the entire continent. But there are some areas of Sydney which I think they've maxed. Maybe it's for the short term, maybe it's for the medium term, but they've maxed in terms of their rental growth. I think you'll see them plateau out, whether that be because of affordability or whether that be because supply is coming on. I'm not quite sure yet.
Yeah, and we spoke about sort of Queensland, rural New South Wales, rural Victoria. As a avid reader of The Land every Friday, Stephen, agrarian or agricultural economies are in rude health at the moment in Australia. Farmers are doing it pretty good, despite some of the weather challenges that they're facing. Fair bit of money washing around in
there is
rural and regional Australia, mate. Record prices for steers and
and as you know, that's my background is agricultural. But whilst on the surface, and there is money awash at the moment because of some of these record prices in and around livestock and even grains for that matter.
Grains doing well.
There's an upcoming issue being with the amount of rain that's fallen throughout the eastern seaboard in these areas at a time where, as an example, wheat crops should be getting the driest, hottest weather to what they call finish off those grain crops and get high protein levels. They're underwater.
Yeah.
And so what they were going to get as high quality, high protein grain is now going to be classified, a lot of it, as what they call feed wheat. Yeah. And you'll get very little for it. And then the summer crops, because a lot of these people are underwater still or the ground is too wet, they won't get the machinery into the paddocks to start planting their summer crops. So there could be a bit of an inflection point there in and around the confidence piece.
So does that matter for then rural and regional property markets?
Yeah, it does, because that money flows through into the localised economies and starts to, I guess, ebb outwards. So the smaller regional areas, it'll have a massive effect on them. Potentially, if the weather doesn't clear itself up. And
it's another big weather event hitting us right now.
Correct.
And cars flowing down the street.
Queensland, that's New South Wales, that's Victoria as well. And what'll be interesting, what'll be interesting though, as a side note, because of the weather patterns and the destruction that it's caused, is what the state and federal governments will throw out there in terms of money spend to fix what's been decimated: roads, schools, infrastructure.
Mate, good luck driving around regional rural Australia at the moment, and just a pothole dodge, right?
It's shocking. But what I guess my point is, that's going to add to those inflation numbers as well.
Yeah,
it's like you couldn't write a script for what's happened in the last 3 to 4 years. Like it'd be sci-fi, but here it all is. Wow.
Well, there we go. Well, the Smart Property Investment Show, the sci-fi property armchair economists. It's
backdoor fiction.
Backdoor fiction. That's good, Steve. Thanks for the update, mate.
Yep, welcome.
Goes to show the continuity of markets right across Australia, but also the discrepancies and changes to them. And back to the point around being no one's market, a smart investor will find opportunities in all those markets. So hopefully that's helped you shape and frame your decision making around that. Sounds like some places are good to be investing right now, some places not so good. That always changes over time. So keep connected, keep engaged. Steve Waters, Director of Right Property Group, thanks for your time today. Always valuable.
Welcome.
And hope you enjoyed that. Everyone, remember to check out smartpropertyinvestment.com.au, social media, Smart Property HQ. If you like what we're doing, please keep those reviews coming wherever you listen to this podcast. Most of you on the Apple iTunes, the team get a real kick out of it. The fact that we're helping you do what you do better. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Would you like the latest news and insights in HR, leadership and people management? HR Leader has you covered. Subscribe at hrleader.com.au.